In this session, I'm going to talk about how this stress testing in banks has changed after the typical financial crisis in 2008. See, one thing was clear during that point when the crisis has actually broken down. It was very clear from the regulators' perspective, from the players in the financial market perspective, that whatever the typical traditional risk measures that were there, which was like okay, whatever the tier 1 capital ratio, the capital adequacy ratio, that whatever have been the numbers that were specified towards these various traditional risk measures, that was insufficient altogether. That is very clearly evident because at that point in time, most of the banks were maintaining these particular ratios quite comfortably, but still the crisis has broken out to a large extent, which means those traditional capital related ratios and all may not be sufficient enough. So that is what has brought out a kind of a supervisory stress testing mechanism. Supervisory stress testing mechanism where uh, there has been a major program called as ESCAP, Supervisory Capital Assessment Program, which is like at a macro level, at a typical global level. This has been performed as a stress test after this typical 2008 crisis. The major objective is not just one size fits all kind of approach, but rather than it to see how much the capital for each financial institution or a bank perspective, how much capital and liquidity are required for each particular bank, specifically to each particular financial institution to support its business, because some banks and financial institutions are more risk taking compared to the others. So identifying more and more specific related capital requirement as well as the liquidity needs is one of the major objective coming out of this supervisory capital adequacy program. Typically when we are talking about the world of stress testing, earlier the stress tests were very probably I don't call them simple, but they are very easy to compute kind of stuff, because the focus was always on single shocks. How would the portfolio get impacted because of single shocks? Probably if the typical mechanisms were volatility increasing by a certain percentage, or interest rates changing by a certain percentage, giving a shock on one of them at a time and seeing what is the impact on the portfolio. Even it was on with respect to macroeconomic variables, like if the unemployment percentage has increased by 2%, what would be the impact on the portfolio value. So there were some econometric related variables that were modified or shock that were given to shocks. There were macroeconomic related variables that were given a shock. But what we are seeing is each one of them given a shock separately and seen the impact on the overall portfolio. That was the typical stress testing that has happened before that supervisory capital adequacy program. Whereas when we talk about after after the supervisory capital adequacy program, we could clearly understand that the focus is on the overall market-wide stressing. Overall market-wide stresses occurring, multiple factors are being changed at a time, and because obviously there could be a lot of correlation that could exist between the various factors. Volatility increase could have a resemblance, could have some kind of an impact on the interest rates, could have an impact on the unemployment. So what we could see is correlation between these various factors has become more and more important. So the stress testing, the improvement that has come post the supervisory capital adequacy program was the stressing was done taking multiple factors together. And earlier, the focus was primarily on the individual bank products, or typically one typical business unit. The focus was not on the overall firm. The focus was on individual products. Are the individual products self-sustainant? What is the risk associated with each of the business units rather than looking at the firm as a whole. Even that changed with the supervisory capital adequacy program. And the focus has shifted completely from just looking at the earnings related shocks. How is the profitability impacted was the major thing that is being looked at. But now the focus has moved from just visualizing what is the impact on the profitability. It is also the test variable has moved to capital adequacy. It's just not the profitability of the bank by changing all these things. Is there any kind of liquidity related issue coming up? Is the capital becoming sufficient, or is there some kind of capital inadequacy coming up because of this? So that became a major focus in the stress testing after the supervisory capital assessment program. And the focus shifted completely from just the losses related stuff, because from earning shocks what you get is what is the loss itself. But here the focus has moved to how are the revenues changing, how are the costs changing, and finally how are the overall losses getting impacted. So so in short, probably I can say that the stress testing has moved from more of a static kind of a nature to dynamic, because it is becoming more and more path dependent, depending on how the how one variable has moved. The dependency on the other variables is coming up accordingly, and based on that the stress testing exercise is getting performed. So in a way the stress testing has become more and more stringent after the 2008 financial crisis. This is again the major objective of such a kind of an exercise always is to boost in the investors confidence and make more participants come into the financial market. But of course, the biggest challenge from the regulators standpoint is coming out with the coherence, right? Okay, volatility, interest rates, unemployment, GDP. There are so many such kind of factors that could be impacted. So bringing out coherence among the various stress tests, what all combination stress tests need to be performed, what all scenarios, because every variable can be changed drastically. Extreme values can be pulled out for each of these variables, but at the same time the variables whatever the shocks that we are giving to these variables, they have to be more and more reasonable. There should be at least some possibility of occurrence, right? They cannot be completely virtual kind of. Probably volatility increasing by 2% or 5% in a day may be possible, but the volatility changing by 20% in a day may not be plausible at all. Or a stock index falling by 5% in a day may be possible, but falling by 10% in a day may not be close to possible. So the shocks of such kind have to be really understood and given. So the sensitivities and scenarios, whatever are being considered, they should be extreme, but at the same time they should be reasonable, and there should be at least some possibility of their occurrence. That is what we are meaning by designing a coherent stress testing mechanism. So identifying various factors and the integration or the correlation that is existing between them, and what numbers have to be taken associated with each one of them is one of the biggest challenge that would be available to the for the designers of these stress testers, or probably to make the stress testing more and more usable kind of a mechanism. Probably if we simply talk about, let's say if the volatility is changing, right? Probably the moment the volatility is let's say increasing, the credit market freezes, right? Volatility increases, the credit market will freeze. Or probably if the unemployment levels are higher, there might be possibility that the equity index will keep falling. So understanding the relationship, correlation between each one of them is a very important aspect when the designing of these kind of coherent stress test measures come into picture, especially when you are dealing with mark to market portfolios. The stress testing, designing such kind of stress testing measures become even more difficult, where the multi-dimensional scenarios need to be looked at. Probably the stress testing becomes more and more challenging. So when we look at the supervisory capital adequacy program, which had brought out the modifications to the stress testing universe, it had focused on three major variables. What was the change in the GDP levels? What was the change in the unemployment levels? And probably the housing price index, it is taking as a measure of inflation. So using these things, it is trying to come out with the stress testing mechanism. And otherwise, earlier, every bank used to have the same routine mechanism for computing the stress testing. But of course, after that, after probably 2011, where they have come out with comprehensive capital analysis review, we call it as CCAR, comprehensive capital analysis review. Even it is coming out to more and more customized kind of stress testings to the banks, catering to their own requirements and the risk levels of the products that they are offering. So typically when we talk about another challenge, okay, even when it comes from a SCAP program, just now we have seen that whatever the stresses are getting designed, they are based on three macroeconomic variables: the change in GDP, the change in the unemployment levels, and housing price index. Now, how well I am able to translate these macroeconomic risks to the company specific numbers, because different companies may react differently to these macroeconomic variables. Some of these variables may not be a risk to a particular company, whereas some of them may impact the returns of that company quite drastically. So geography specific, right? Probably a one size fits all kind of an approach may not be relevant in this kind of a scenario, because geography could be one of the major differentiator. In some geographies, probably the risk is not that heavy compared to the others. Even to the various asset classes, also the risk taking levels will typically differ, and also the risk taking levels also differ with respect to the business cycles. Probably when the economy is booming, the risk taking levels are much higher compared to when the economy is on a falling note. So the stress testing scenarios that have to be designed, they have to be, they cannot just restrict themselves to these three factors. And if they are developed with these three, how well I link it to my various company specific risk factors is one of the major challenges that need to be focused. And one more dimension here is Stressing the balance sheet. The typical, when we are talking about stressing the balance sheet or coming up with a balance sheet model, we talk about a stress test for a 2-year period. And after the stress over this 2-year period, I need to understand, I'm making modifications to the income statement, projecting the income statement and the balance sheet, and tested out using the stress test scenario, and finally testing out if the capital is adequate after the stress test during this 2-year period. So when we are talking about in this, so we are developing it on a quarterly basis. The first quarter's income is generated based on a stress scenario, and using that income statement, we are generating the quarter end balance sheet. Like that, for 8 quarters, the same procedure is repeated. So, and probably if required at the end of each quarter, there can be some kind of assumptions that could be made, like if any assets would be sold, or new assets are going to be bought, or is the capital getting depleted, or any other acquisitions kind of thing coming up, spin-offs kind of thing coming up. This kind of stressing, or any kind of share repurchase is going to happen, any dividends are going to be paid. All these kind of things can very well be modeled as a part of this stress testing mechanism. And now the key challenges is across all the quarters, the capital has to be maintained, the liquidity levels has to be maintained, and based on that, even the banks have to come out with estimation of the reserves to cover the loan losses that are coming up in the next year. So 2 years is the stress testing period, and at the end of the stress testing period, even the reserves need to be adequately sufficient for covering the losses of the next period. So that is going to be a real tough challenge. So whatever is the first quarter's income and the losses that are coming out of the P&L statement at the end for the first quarter, that is getting used to prepare the balance sheet, and over a period it has to see that for the entire period bank has to see whether the capital, liquidity, all the required ratios are being met based on the stressed scenario itself. That is going to become a big challenge as a part of the balance sheet modeling process. And when I look at the SCAP, finally, when I have to look out for SCAP specifically, the key thing that came out as a significant feature for it is the disclosures aspect, bringing in more and more transparency into the process. So at any point in time, the market can really check out for the severity, how severe is the stress test scenario, and the outcome of each and every individual bank can very well be assessed. So that is one major thing that came out of this entire SCAP program, right? Though it has gone with three simple dimensions: GDP growth, unemployment index, as well as the housing price index as a measure of inflation. It is able to look out. This mechanism was quite successful in looking out at an individual bank level the losses and losses or asset related, product related losses to be assessed. And probably the good thing about that escape mechanism was the banks, almost 19 banks which were tested under the escape program, they were required to raise $75 billion. They were required to raise $75 billion within 6 months. So that is the kind of a shortage that has been identified by the typical SCAP program. And whatever almost 77 billion in tier 1 equity capital has been raised by all these banks which had undercapitalization, which were undercapitalized. But following that, we had even few more stress testing mechanisms. One in 2011 as a part of CCAR. So what had in that case, the banks were submitting from their own baselines and stress scenarios. The banks have submitted the results from their own stress testing and their own baseline kind of scenarios, and only the macro results were published, not an individual bank level kind of disclosure. Whereas when it came to CCAR in 2012, again their own baseline and stress testing results. Whereas here at a micro level, whatever the SCAP of 2009 was focusing on, the CCAR of 2012 also focused on bank level as well as asset as well as product level loss rates rather than just the macro level kind of publishing. So, which in a nutshell, all we have to understand is the stress testing has become more and more important of late after the 2008 financial crisis, and various dynamic and path dependent and innovative kind of mechanisms are coming out towards the stress testing process. And it's very important for us to understand the latest happenings in this stress testing phenomenon, because that is one of the most growing and challenging areas in the upcoming years. I hope you got a brief overview about the stress testing which has been done in the various banks. If you have any further queries regarding this, you can very well get back to me by giving me a call on the number that I have provided below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.